Welcome back to the channel. I'm Algabot, and every video here we take one automated MetaTrader 5 strategy and pull it apart, gear by gear, so you can understand exactly how it thinks. Today we're looking at a strategy called Empirical Mode Regime Shift. It's built on a signal processing idea from John Ehlers called Empirical Mode Decomposition, which splits price into a cycle part and a trend part. By the end of this video, you'll understand how it decides the market has shifted from choppy consolidation into a genuine trend, and how it acts on that shift. This is educational content only, so let's dig in. So what is this strategy actually doing at a high level? Empirical Mode Regime Shift is a trend-following expert advisor, but it approaches trend detection in an unusual, signal processing way. Most trend systems compare price to a moving average or a fixed threshold. This one instead decomposes price into its underlying components, borrowing from a technique called empirical mode decomposition, popularized for traders by John Ehlers. Here's the core idea. The strategy takes the median price of each candle, the high plus the low divided by 2, and runs it through a two-pole bandpass filter. A bandpass filter is tuned to a specific frequency, so it isolates the market's dominant swing cycle while rejecting both the very slow background drift and the fast tick-by-tick noise. What comes out is a clean oscillation that represents the market's rhythm. From that oscillation, the strategy builds two more layers. First, it takes a simple average of the bandpass output over the cycle period, which it calls the trend of cycle. When the market is just oscillating back and forth, that average hugs zero. When a real trend develops, the cycle spends more time on one side of zero, so the average drifts away from zero. Second, it measures the market's own recent swing amplitude by averaging the recent peaks and valleys of the bandpass, then scales those into adaptive upper and lower bands. Because those bands breathe with volatility, the strategy adjusts itself to each symbol and each market condition without manual tuning. Who is this style suited for in an educational sense? It's aimed at traders who are curious about cycle analysis and adaptive, self-calibrating systems rather than fixed rules. It only takes a position when the regime genuinely flips, so it aims to sit out messy sideways periods. As always, remember that trading carries real risk. Losses are a normal part of any approach, and nothing here is a promise of any outcome. Let's walk through the exact logic, step by step. Everything happens once per completed bar, so the strategy waits for each candle to close before it thinks. Step 1 is the bandpass filter. The strategy feeds the median price into Ehlers' two-pole bandpass equation, tuned to the cycle period, which defaults to 20 bars, and shaped by the bandwidth parameter, which defaults to 0.30. A smaller bandwidth gives a narrower, tighter isolation of the cycle. The output is a wave that oscillates around zero, tracking the market's dominant swing. Step 2 is the trend of cycle. The strategy takes a simple average of that bandpass wave over the cycle period. Think of it as asking, on balance, has the cycle been leaning positive or negative lately? A market that only chops keeps this value pin near zero. Step 3 builds the adaptive bands. Over a longer look back, the peak window, which defaults to 50 bars, the strategy finds every local peak and every local valley in the bandpass wave and averages them. It then multiplies those averages by the threshold fraction, defaulting to 0.50, to create an upper band above zero and a lower band below zero. If no clean turning point exists yet, it falls back to the highest and lowest values in the window. These bands are the heart of the method, because they force the trend estimate to clear the market's own recent swing size before anything happens. Step 4 is the regime decision. If the trend of cycle rises above the positive upper band, the regime is up. If it falls below the negative lower band, the regime is down. Anything in between is consolidation, and the strategy takes no new trade there. Now the trading rule, and it's deliberately strict. The strategy acts only on a regime flip. When the regime turns up, it closes any short and opens a long. When the regime turns down, it closes any long and opens a short. If the regime merely cools into consolidation, the strategy holds its current position, on the reasoning that the trend paused rather than reversed. The long and short rules are exact mirror images. For risk control, both stop loss and take profit are scaled by the average true range. The stop sits at the AtrStop multiple, defaulting to 2 times ATR, away from entry, and the take profit is placed at the reward-to-risk multiple, defaulting to 2 times that stop distance. Because ATR expands and contracts with volatility, the protective levels travel with the market. Let's read the MQL5 the way you'd see it in MetaEditor. At the top are the inputs. CyclePeriod, defaulting to 20, sets both the bandpass tuning and the trend averaging window. Bandwidth, at 0.30, controls how tightly the filter isolates the cycle. Peak window, at 50, is the look-back for averaging peaks and valleys, and ThresholdFraction, at 0.50, decides how much of that average becomes the trigger band. Then come the risk inputs, ATR period 14, an ATR stop multiple of 2, and a reward-to-risk multiple of 2. Now the decision block. The strategy sets the regime to 1 when the trend of cycle is above a positive upper band, to -1 when it's below a negative lower band, and to 0 otherwise. The 2 flags, flip up and flip down, are only true when the regime has just changed from what it was on the previous bar. That is the entire entry gate. On a flip up, look at the long block. The stop distance is the ATR stop multiple times ATR. The strategy buys at the ask, places the stop below entry by that distance, and sets the take profit above entry at the reward-to-risk multiple times the stop. The trade.by call sends the long order. On a flip down, the short block mirrors it exactly. It sells at the bid, puts the stop above entry, and places the take profit below entry at the same reward-to-risk multiple. The trade.sell call sends the short. Same logic, opposite direction. Let's walk through this illustration candle by candle, because this is where the strategy really comes to life. In the lower panel, you can see the indicator this strategy is built on. The trend of cycle, the gold line, derived from Ehlers bandpass filter. It oscillates around the 0 line in the middle. Above 0, you see the dashed adaptive upper band, and below 0, the dashed adaptive lower band. Remember, those bands are not fixed. They expand and contract with the market's own recent swing size. Look at the first 3 candles. Price is drifting sideways and slightly lower, and the gold line reflects that indecision. It dips below 0, pops back up a little, but crucially it stays inside the 2 bands. Because the trend of cycle has not cleared the upper band or the lower band, the regime is still consolidation and the strategy stands aside. This is exactly the kind of chop the adaptive bands are designed to filter out. Now watch the third candle. Price pushes up with a strong close, and the gold line surges above the adaptive upper band for the first time. That crossing is the moment the regime flips from consolidation to up. This is where the buy entry marker appears. The strategy closes any short it might have held and opens a long. Right away, the stop loss is placed below the entry at 2 times the average true range, and the take profit is set above at twice that stop distance, giving a reward to risk of 2 to 1. From there, follow the next few candles. Price climbs steadily, candle after candle, making higher highs and higher closes, and the gold line rides high above its upper band, confirming the regime is firmly up. The strategy simply holds. Around the 7th and 8th candle, the rally reaches the take profit target and the long position is closed at the take profit marker. That is the reward side of the 2 to 1 plan being reached in this illustration. Now the character of the market changes. Price stalls near the top, then begins to roll over. Watch the gold line fall back towards 0, then keep dropping. It slides below the 0 line, and by around the 10th candle, it pierces the adaptive lower band. That crossing is the regime flipping from up to down. Here the sell entry marker appears. The strategy closes any remaining long and opens a short. The stop loss now sits above the entry at 2 times ATR, and the take profit is placed below at twice that distance, the mirror image of the long setup. Follow the final candles down. Price prints lower highs and lower lows. The gold line stays pinned below its lower band, confirming the downtrend regime, and around the 12th candle price reaches the short take profit target, closing the trade at the second take profit marker. Notice the whole rhythm. The strategy waited patiently through consolidation, entered only when the trend of cycle cleared the adaptive band, and reversed cleanly when the regime flipped the other way. That patience in the middle is the entire point of the adaptive band design. So that's empirical mode regime shift from top to bottom. We saw how it uses Ehlers bandpass filter to isolate the market's dominant cycle, how it builds a trend of cycle and adaptive peak and valley bands, and how it trades only when the regime genuinely flips from consolidation into an up or down trend, with ATR-based stops and targets protecting each position. If you found this breakdown helpful, please give the video a like, subscribe for more MT5 strategy analyses, and drop a comment telling me which strategy you'd like me to examine next. You can find more educational material over at www.algobot.live. And a final reminder, everything in this video is educational information only, not financial advice, a recommendation, or a solicitation to trade. Trading involves real risk, and losses do occur. Past performance does not guarantee future results. Trade responsibly.